Welcome everyone to today's live stream. I'm excited to talk to you about this subject, which is, I think, important to a lot of people. How to supercharge your TFSA. TFSAs are widely used investment planning tool, and we're going to go over today how to use your TFSA properly, what goes inside of a TFSA, and comparing it to another alternative that you could use that's also offers tax-free investing as well. So I'm looking forward to your comments. If you are new to my LinkedIn channel or new to my YouTube channel, I go live every Wednesday at 11 o'clock. Might change that to 10 o'clock. If you are new to the channel, please remember to subscribe to the YouTube channel. So let's get right into this. We're gonna just do a quick review now of tax-free savings account. Now, believe it or not, on the government's website, this is their definition of a tax-free investment. So they define tax-free savings accounts as flexible, registered, general purpose savings that allow Canadians to earn tax-free investment income and to more easily meet their lifetime savings needs. When you think about tax-free savings account, people often dismiss them in the very, very beginning in 2009. People thought, well, that's nothing. What am I going to do with that amount of money? But the value of having a financial advisor, help you in terms of planning, this is the real key here, because we're trying to see well beyond what you're seeing. We're looking at how much money you're going to need in retirement, what the tax is going to be, what kind of income streams are going to be made available to you at retirement. And so if you think about tax-free savings account use of money at retirement, let's say you retire at 65 and you plan to take your money, Canada Pension Plan, Old Age Security at 65. You plan on taking your RSPs at 71, but you're going to retire at 62, 63, which is, by the way, the average retirement age in Canada. So there's a gap between, say, 62 to 65 when you start receiving your government pension plan or government benefits. So that is really a perfect use of a tax-free savings account, having capital available to you that you don't have to pay tax when you withdraw it, to fund that gap between the retirement date and when you start taking your CPP, and then obviously when you start to take your RRSPs. So it serves a great purpose. Now, when you think about the total amount of money in a tax-free savings account that you could have put in now, which is $75,500, combined a couple, that now becomes a very useful and needed planning tool, because having $150,000 and then having that grow to $250,000 by the time you get to retirement, that's a significant source of income. When we say income, it's not taxable, but it's a significant source of money for you to use in those gap years. And that spreads the ability to push off your RSPs as long as possible so it continues to grow tax deferred. So that's financial planning, right? And so let's dig into a little review, right? Tax-free saving highlights. So the growth of the account is tax-free. So you don't pay any income tax on what you're making inside of your tax-free savings account. Now, there is some limitations, right? The limitation to deposit is $6,000 per year. And you could have put in as high as $75,500. That's as of 2021. Now, this is a very surprising, this third point. What types of securities can you invest in a tax-free savings account? I see so many people in the later part of having that high interest savings account. You can put GICs, ETFs, this is exchange traded funds, stocks, bonds, mutual funds, segregated funds. There's a host of different securities that you can put in your tax-free savings account. Looking again, you've got risk. So what is the risk level to you in investing in tax-free savings account? Well, it depends on you. It can be low, it can be high. It depends on what you're investing in. So if you were in, let's say you put GIC. GICs serve the purpose, but my goodness, please call me if you got money in GICs, because there's so much of a better alternative than a GIC. But let's say you were ultra, uber conservative and you wanted a GIC. Well, that's low risk, right? as compared to saying, I'm going to put my money in a high risk investment, consider. Now, going back to here, subject to market volatility, the value of your tax-free savings account is going to go up and down just as it would in your RSP or non-registered account. Cash can be withdrawn at any time. That's true. So that is the flexibility of a tax-free savings account. And yet, one of the things I notice about a lot of people is they use their tax-free savings account as a revolving door. Think about the way that you're using your tax-free savings account. When you deposit your money, are you taking money out in the same year? Is that sort of happening every single year? You put money in and then you take money out because you need it? Well, it's defeating the entire purpose of a tax-free savings account because you're not benefiting at all unless you were trading and you made a lot of money and you pulled it out. I'm not talking about that. I'm talking about you, the investor who puts money in, and you tend to grow that long-term, but you needed the money right away. So you're kind of in and out of the tax-free savings account. Defeats the purpose 100%, and you might as well not use a tax-free savings account because you're not using it for the purpose of what it was meant for. And the effect on government benefits, there's no effect since the TFSA withdrawal are not considered income for tax purposes. So what do we mean by that? When you are going to start collecting your CPP and your old age security, specifically your old age security, you are going to be penalized if you have a high income during retirement, and it's called a clawback. And that's important. So if you have a tax-free savings account and you pull money out and you think, well, that's just going to add to my income, it doesn't. Okay, so now what I mentioned before, the improper use of a tax-free savings account, this is really simple. Look at this graph, and this is a representation of the way that you should use or structure your accounts. So if you look at going the top right-hand corner where you see that red arrow says proper position of a tax-free savings account, call it a bucket of cash that you have invested in different types of investments, some equities, bonds, alternatives, that could be REITs, real estate investment trusts, and then cash in equivalents. Depending on your risk tolerance, you're going to have a different mix of that, right? You hear of people, very common in Canada, having a balanced portfolio. That's a mix of equities and bonds. That bucket is the long-term use of your money. So see that it's more on the 15 years at the bottom of the page. It says long-term and legacy needs. So that bucket is the long-term investing that you're doing that's going to provide income for you as you need it in retirement. We're going right to left now. So that arrow, that gray arrow, silver arrow going into the middle bucket. So we call that a bucket where from there, you're going to take money out of that bucket to put it into that green bucket. That's your lifestyle, right? So you're going to be spending whatever your lifestyle is going to be. That source of money comes from that middle bucket. You can see here that the way that you might invest in the top right-hand corner might be more higher risk. You're trying to get long-term capital appreciation of your assets in that bucket, right? And then you take some of that money and you push it to the middle bucket and you say, this is going to be the thing that pays for my lifestyle in retirement. So the risk profile for that particular asset is going to be much less than the top right-hand corner. So where is the proper use? Well, it could be in the top of the TFSA, it could be in the top right-hand corner, it could be in the middle bucket as well. But where I see it very often is the bottom left-hand side, where the green circle is, and you see to the left it says incorrect position of a TFSA. This is that idea of people using their tax-free savings account as a revolving door, where they put money in and take money out. That's your checking account. A tax-free savings account is for you to be able to invest money, grow it over time without paying any income tax. So that'll provide an income for you, a non-taxable income for you, and retirement. So do not use your tax-free savings account as a revolving door. Resist that temptation. Work with an advisor to come up with a strategy where you can look at your needs month over month to determine how much money you need to keep in your checking account for your lifestyle, and come up with also 3 to 6 months worth of expenses, so that if those things, a lot of times many people take money out of their tax-free savings account because they have an emergency. And so that's really about cash flow. How do you use your cash? A better idea would be to come up with an emergency fund that is 3 to 6 months worth of your monthly expenses. And when those emergencies come up, as they often do, you tap into that cash and you go ahead and fund that emergency and leave your tax-free savings account alone. Even if it's a small amount you're putting in, let it grow. Let it compound on itself. Don't take it out. Okay, so that's the proper way to do that. Let's look at how to blow up your tax-free savings account. And as I said before, it's not what you're thinking. I'm going to share with you about cash value life insurance. And people are going to say, are you serious? Yes, I am serious, because the similarities between cash value life insurance, so dividend paying, is very similar to a tax-free savings account. And let me show you why. Cash value. So this is different, just so we know, this is different from term insurance. This is you investing into a permanent life insurance. We call it dividend paying. So you're receiving cash. It's not term where there's no cash. You're actually putting money into your life insurance. So you got life insurance, but you're being paid by the insurance company every single year, right? And that's very important. So what I want to share with you is, when I say these bullet points, compare in your mind tax-free savings account. Compound growth of an account is tax-free in the life insurance. Well, tax-free growth in the tax-free savings account. So if you're thinking about where you can put your money in a tax-free environment, there are two choices. And why am I bringing this up? Because people are thinking about, I only have so much money. I also know that I need life insurance because I want to protect my family in case of early death. And if I have even more money, I want to try to provide some kind of liquidity to my estate to pay any taxes on my estate, so my charities and my children and my spouse get more money. In this particular case, we're saying, what if you didn't have enough of money? What if you had to be really thin with your deposit? I mean, think about the average deposit in an RSP in Canada is below $5,000. The average deposit into a tax-free savings account is not the maximum of $6,000. It's below that. If you're in that average category of deposits, then you actually have three places you should be thinking about: RSP, TFSA, or life insurance. And I'm going to tell you why you might want to choose life insurance. So let's look into this. Let's dive deep on this. Tax-free growth inside of the life insurance policy. There's no deposit limit. The source of growth is from annual dividend. When you are investing in a tax-free savings account, the growth comes from how well the securities that you have invested in are actually growing over time. And I'm going to talk to you about market volatility in a second. In a life insurance policy, it comes from the annual dividend from the life insurance. The dividend is coming from their profit. The risk is low in life insurance. Funds are diversified. And about 70% of the money that's held inside of life insurance is in fixed income. Zero market correlation. You can withdraw cash anytime. It's not going to affect your government benefits. This is, again, those are the two more things that are the same as tax-free savings account. But here's the big difference. It's going to 10x your cash value into tax-free death benefit. It's life insurance after all, right? So you deposit money into a life insurance policy. You've got the cash, it's there, but you also instantly get a tax-free death benefit. So while you're investing, you're also taking care of a second goal that you had, and that was, I want to protect my family from early death and from a host of other things that I might want to protect my family from. You're going to buy it anyway, so why not just buy one product that does the two things for you? Now, we talked about volatility. This is 2008, 2009. If you remember this, comment please below, because this is something that scared the heck out of everybody. People were really running for cover and they were nervous, and why not? Minus 35%. Worldwide economic collapse. People were scared. But you know what happened in that same year? People that were invested in participating life insurance received about a 7% dividend, while other people had their money invested in accounts that were going down by 35%. People who were invested in whole life insurance, participating life insurance, received 7%. If you just didn't have enough money, where you had some money in RSPs, and so, you know what, I'm going to use life insurance to both satisfy a tax-free growth scenario, and I also need life insurance, then that portion of your money didn't decline in 2008, 2009. You actually made money. And in February, March of 2020, when the market went down, in 2018, when the TSX was minus 1.5%, in all those times, you were still getting this 7% or 6%, depending on where you are and what kind of company you're with. If the dividend is different, but it might be anywhere from, say, 5 to 7% right now, depending on where you are. So you think about that consistency of constantly getting a dividend year over year over year, compounding on itself, tax-free. The insurance companies have never missed a dividend, an annual dividend, so that's the strength in that. And you get to mitigate these crazy times when the market goes up and down. So if you think about different kinds of asset classes. So let's look at this. You have a dividend scale, that's that sort of gold line going across the screen. Very, very, there's absolutely no volatility there. That bluish teal colored line, that's the Toronto stock market, up and down, up and down. So you notice those downs, those are the things that get everybody worried, especially if you're near retirement. This is a terrible thing to happen to you when the market is declining like this 5 years before retirement. In 2008 and 9, it took almost 5 years to see people get back to their original balances. With the life insurance, no problem. You were getting the annual dividend no matter what. And then, of course, you see the GIC, the dotted line, that's a 5-year GIC, and then government, 5 to 10-year bond. Those are the low risk, low return. One thing more I want to share with you before we go, there's only one more thing left, and that is, what else can you do with a life insurance, a cash value life insurance, that you can't do with a tax-free savings account? So you get the tax-free growth, right? You can take your money out anytime you like. It's not going to affect government benefits. But that's where you leave tax-free savings accounts behind, and the life insurance starts to just supercharge what you're doing. Here's what I'm talking about. If you're talking about the way you should use a tax-free savings account as long-term investing, and you look at life insurance definitely as long-term investing, then you think about where are the balance is going to be after a certain period of time. That would be the interesting thing to do, is to compare what you could do with balances in a tax-free savings account and what you could do with balances in your life insurance. So imagine today you're getting close to 65 or 60, and you've got all this cash and you're thinking, okay, how am I going to use the money in retirement? Let's look at that. So in a life insurance policy, you have the possibility to leverage the cash value. So you can actually have a bank, use it as collateral, and borrow against that. So let's say you went to a bank and you got a loan for 4% in your cash value. So imagine you go to the bank and you go, I've got 300,000, I got 500,000, whatever number that is, in cash in your policy. The bank is going to give you a loan, say at 4%, and it's guaranteed for the bank. This is a zero risk loan for the bank. If you actually pass away, the bank's going to take your death benefit, pay off the loan, and give the rest to your family tax-free. So no risk that way. If you don't pay the loan back, they'll just say, okay, we are going to take the cash that you have from your life insurance, pay that off, and then restore your life insurance back to you with what cash value is there. So you take that to the bank, you get a loan for 4%, and now you take that money and use it for whatever you want. There is nothing you can. If you wanted to go buy curtains with it, you can buy curtains. But if you want to buy an investment property, that would be really cool, because then the loan becomes tax deductible. If you're taking that money that you borrow and you're going to put it into something that is for the purposes of getting a return, an investment return out of it, then that makes the loan tax deductible. So depending on your tax rate, it could be maybe 2%. If there's one thing you're going to learn from this, it's this right now, and that is, if the after-tax rate is about 2% for you, and you're making between 5 to 7% tax-free return in your life insurance policy, do you see what's going on? You're actually getting paid to borrow against the cash value. You're making money borrowing against your own cash value to invest in another property. And this is exactly what people are doing to be able to leverage their cash value later on in life, to be able to amplify the amount of money that they've got, to be able to take that and say, I'm going to put it into another investment, whether they give it to their kids to buy a home, or whether they bought a condo or pre-construction or bought a cottage or started another business. You do whatever you want with it. But if you're using it to actually make money from it, then it becomes tax deductible. So you're actually getting this 5 to 7%. I'm going to repeat it because it's so important. You're making 5 to 7% tax-free dividend to your life insurance policy, and you're borrowing it at the bank at about 4%, maybe less. And your after-tax is about 2, maybe 2.5%. So do you see what's going on here? You're actually making money to borrow money. This is the craziest thing, and people say that's too good to be true, but it's not. That is the way life insurance works in Canada. We're the envy of the world. Dividend, cash value, growth inside of a policy in the United States is taxable. Here it's not. So we are the envy of the world of being able to do this. So I would say to you this: if you were going to choose one, if you couldn't do all three, I would say choose your RSP, choose a life insurance cash value. dividend producing life insurance. If you have questions, let me know. I'm happy to explain it in more detail in a one-on-one Zoom meeting. But I would say do those two things, because you are going to amplify the amount of money that you have in your available to your retirement, and you're also going to be doing your family another great thing, and that is having a lot of insurance for you to pass on to your kids, to your charities, and that's, I think, so important. That's all I have for you today. I appreciate you taking the time to be with me today, and I look forward to seeing you next week.